Hello and welcome to Two Blokes Trading. Join us, the two blokes, Tom and Owen, as we dive deep into the complex, exciting and potentially lucrative world of home trading.
This week on episode 22 of the Two Blokes Trading podcast, we hear from a young, ambitious trader and fan of the show, and attempt to answer his questions on binary options, trading styles to suit personalities, and beginner account sizes. We speak to Hussein, a leading market analyst, on the differences between equities trading and investing, and Tom and I assess our 3 weeks of equities research and discuss the key differences to forex trading. Tom, hello.
Hello. I love it how you do that in one take. It's impressive, mate.
Yeah, I know. I genuinely did that time as well. I actually had to write it down though. It's too much to remember. I was watching Top Gear rerun, obviously, and thought I could try and do a full Clarkson this episode, but maybe next time I'll practice it first.
Next week, I want to hear a full Clarkson. I want to see best effort and see how it goes.
All right, and then you've got to do your effort, all right?
All right, okay, yeah.
Winner takes all. So we've got a slight departure from the norm for this episode, Tom. We had a really interesting email in from a young chap, an 18-year-old, who is just at the beginning of his trading career, and asked a few questions, ones we may be in a position to answer or may not. And I thought it would be really interesting to spend maybe 10 or 15 minutes now just looking at those topics, because I think they're universal to a lot of people that are starting to learn to trade, and actually probably are quite interesting even for experienced traders.
Yeah.
So what do you say? Shall I read it out?
Yeah, go for it.
Cool. So this came in, I think yesterday, was it? From Mikey from the UK. He says, "Hi guys. First of all, loving the podcasts. Thank you very much. I'm an 18-year-old who recently decided not to go down the path of university, and I'm currently traveling around Thailand, listening to your podcasts on my travels and on the beaches."
I already don't like this guy.
Yeah, that sounds a bit too perfect.
Yeah.
And I really want to go down the route of trading. I've been researching trading, and I've done a bit of binary options trading in the last couple of months. I've only just started listening to your podcast, so I'm only on episode 5 or 6, so you may have already answered my questions, but I do have a few questions that I hope either you two or a special guest could answer for me. So, before I cover the questions, binary options, Tom.
Yes. Not a lot to be said on that not a lot to cover on that apart from have a listen to episode 12. That's where we cover binary options, and the title is Binary Options Scams. We have Andrew Sachs-McLeod, who's the director of a website called Finance Feeds, comes on and has some rather strong opinions of binary options and whether it's a good thing or a bad thing to do.
Yeah. So we'll leave that one there. So first question, Tom, for you. I've decided.
Okay, hit me.
Everything I read and listen to about starting to trade and choosing strategies mentions that different strategies are tailored to different personalities, and you've got to find the one that suits your personality. So my question is, are there any generic or common pairs? So basically, are there any strategies that suit specific personalities?
Yeah, I think that's an amazing question, and that's something that we've been, I'd probably say, researching over the last few months. I wouldn't say we've got a definitive answer just yet. I know that obviously you and I, Owen, have completely different personalities, and I'm more towards give me a set of instructions and I'll make sure I follow it to the letter, and you're more towards
two decades of army training, that one.
I think that may possibly have something to do with it. And obviously you are you coming down from the academic side of life, thinking you need to know everything before you can make an informed decision. Bollocks. And
I heard that.
So, and therefore you're more leaning towards the fundamental side of things. But ultimately, I think that we need to. I think that's a great question. I think that's definitely a good couple of podcasts in that, and we'll go away and do a bit more work on that.
Yep, agreed. I think we mentioned possibly on last week's episode that we're going to be doing, or maybe I tweeted it, I'm old and forget what I've done, but that we're going to be doing a few more episodes, maybe around the idea, the trading psychology area. We obviously covered trading the zone quite heavily, and there's a lot more out there that's been said and written since then. And I think this falls into that. And it is that main question you want to answer when you're just starting out. How do I choose my trading strategy? And I think personality, a few people have said it to us on interviews, personality is the big thing. Don't choose something that doesn't match your personality. And I think that's everything from how you like to take in information to, how patient you are. Frankly, if you're full of energy and you're, kind of like an ADHD adult, like I know a lot of people are, you want to trade every day or every hour, every minute, then, that's going to impact on how you're going to trade. But like you say, I think there are people out there better placed to answer that one than us. So we'll get someone on, Mikey, a couple of weeks, and we'll let you know. All right, so this is question 2, and I'm going to have a stab at this one. For someone as young as I, to start thinking about going down this path, bearing in mind that I have little money, what should I do? I really want to start trading as soon as I can, obviously with the proper knowledge, but should I first get a bar job and save up for a couple of years, or are there any ways around the limited money and experience? So I think that is really is the key question, isn't it? Because not everybody is going to become a doctor or a lawyer and save up for 10 years and have 50 or 100 grand in the bank and then think, I'm going to start to trade. A lot of people want to do this early doors. And then by the time they're where that doctor or lawyer would be, they're already great at trading and hopefully will have some money. Mm-hmm. I'm worried, Mikey, by the idea that you would go and work in a bar, which is hard work. I've done it. It's not easy. And to save money off the back of it, because you don't necessarily get very long shifts, is difficult. And save for like 2-3 years and get 5 grand together. Deny yourself loads of things in life. Deny yourself going out with your mates, having a good time, which you should be doing at age 18. I didn't bother to save when I was 18. And then to start trading and either A, find out that you don't really like it, and you could have just been having a great time in Thailand on the beaches and going to the full moon party and spending your money on fish bowls of psychedelic blue rubbish, or you start the trade and then you lose all the money very quickly. And it's very common that, you know, new traders will either blow their account right away or grow it very quickly, get overconfident and then blow it. That would be a complete disaster, because it sounds like you won't necessarily be in the position to then go away and earn another 5 grand, 10 grand, put that away in a few months and start again. On the flip side, we're always told, and we've been told by a lot of people, don't demo trade, or at least don't demo trade beyond getting to grips with the basics of the platform. You know, actually trade real money. But the reason you want to trade real money is because that is, you need skin in the game to make genuine trading decisions, because you need to be able to work out how to trade without fear and trade without greed. And if there's no money in the game, then you're not really trading against your personality, which is actually what we've been learning a lot of, a lot of trading is. So I would say personal advice, I'm not the most experienced trader. There are probably other people better placed to give advice, but I would say start trading with real money now, whatever you can afford. And the good thing is, with modern technologies, with things like spread betting and CFDs, you can literally put £100, £200, £300 into a platform. And I think if you're UK based, you can do it in a spread betting platform. Bet 25p a pip, bet the smallest amount you possibly can, and find out if you like trading, and if you take the losses too hard and you can't handle it, or if you get too euphoric with the wins and you go off the rails. Find out if it holds your interest. You're 18. There's loads. You can do anything with your life. You don't have to trade, but don't go and waste 3 years of your life saving money in a job you don't like just to then blow it all or decide you don't like it. Start with 300 quid. Start small. You probably blow out the account, but it doesn't really matter, because you can just get another 300 quid or 200 quid and do it again with a different strategy, or having learned something about yourself. That would be my recommendation. Get a couple hundred quid together. Probably try not to do it from a beach in Thailand the day after the full moon party. Come back to the UK, sit in a room with a computer and do it properly after you've finished traveling. What do you think, Tom?
I agree with everything you've said. When you've got a small account, I mean, everyone, generally speaking, the traders we've spoken to so far, I mean, they've said, I think the lowest that a trader's come back to me with, when I've said, how much do I need in an account in order to make a significant or a decent living, the minimum they've said is £50,000 in an account. So if you're looking at trying to be a real professional trader, that's the figure you're looking for. There are other options open to you, which once you become a successful trader, i.e. you are making consistent profits as opposed to losing money, there are things where you could look at, which is places like eToro or DarwinX, that you can go on and trade and prove to the community that you're a successful trader. Then people invest in you, which therefore then you get kickbacks from your trading, and you can make money with a small amount of initial capital. But again,
that's your percentage gains, doesn't it?
Exactly. At least on eToro it does, yeah. So that would be my suggestion. But that's going to be a month or a year down the line, mate, when you've done all the hard work, the graft of learning how to become a trader. But that's one of the options open to you. Yeah. Also, have a look at our website. We've got a broker review page up. Also, Mikey, take a look at our broker review page. Owen's done a lot of work to get underneath the skin of the brokers and to try and help you pick the right broker for you. So have a look on twoblokestrading.com.
All right. I think what you hit there is a really important point, actually. It's like, is Mikey trying to trade to earn a living? Because then obviously, yes, he's going to have to save up some money to do it. But hey, at age 18, maybe just move back in with mum and dad, bank with mum and dad for dinner. You're sorted, and save all the money for trading. But I'll leave that up to you. I know I wanted to move out when I could. Yeah, thanks, Mum. So moving on, Tom, obviously we are still in the middle of Equities month. Okay, Tom, so moving on from Mikey's questions, we are still in the middle of Equities Month, and we have a chat coming up with a chief market analyst who has a background as an equities trader and investor. And we asked him some questions earlier in the week about the differences between equities trading and equities investing.
But first, here's a message from our sponsor.
Bullboard is a powerful stock screening application now available in the App Store. Download Bullboard to your iPhone today for effortless screening of thousands of shares. Set up your criteria, swipe your sentiment, and create watch lists of future trading opportunities. With backtesting functionality and the ability to create multiple portfolios, Bullboard is the most powerful stock screening application on the market. Visit bullsboard.com, bullsboard.com, or go to the App Store to download Bullboard to start screening stocks from your iPhone today. Two Blokes Trading welcomes Hussein Syed, Chief Market Strategist of FXTM Gulf and MENA. Hussein has worked in the financial markets for 14 years as a dealer, trader and analyst, and is a regular anchor on CNBC Arabia. Hussein, welcome.
Thank you for having me, guys.
Hello.
Oh, our pleasure. Thanks for coming on. Hussein, obviously we're in the middle of Equities Month here on Two Blokes Trading. So we are going to get cracking very shortly on today's topic, which is all about diversification of equities portfolios and why that is a good idea. But first, I always like to start with a bit of an introduction. So could you tell me very quickly your background in trading, how you got started and how you got to where you are today?
Sure. In fact, I started my trading career like 14 years ago. The story began when I was a university student. In fact, I was studying graphic design, so something not related to trading at all. I used to be in love with arts and mathematics at the same time, but at that time I just chose to be an artist until there was a vacancy for an entry-level trader. And this is how I got into this world. It was really unexpected. So my plan was just to cover my fees, my university fees, and then find like a full-time job in the graphics industry, but things just changed so fast. I fell in love with tradings, and I found that it combines, it combines both mathematics and arts at the same time. So I really fell in love with this industry. I chose to shift my major then to finance, and then started navigating my way through the investments world. And I worked in different industries, from FX brokers to equities, fixed income, although retail banks and financial advisory firms. And then I just ended to be a CNBC anchor. I don't know how I got there, but since 2008, I was like a regular guest on business and news channels. And then I got a job opportunity over there 4 years ago. And this is where I am. And as well, FXTM Chief Market Strategist.
So you were actually trading as a student. That's pretty cool.
Yeah, this is when it started. At that time, we didn't have like this much kind of advanced technologies in the Middle East. So it was all through the phones, contacting banks. But this world has changed a lot now.
Yeah, well, that's certainly true. But it's great, the technology change, because it means that people like me and Tom, who have never been anywhere near an institutional trading business, can get involved. So we're not going to complain, certainly.
It's much easier, guys, than it was like 15 years ago when I was at the trading desk.
Good. Well, so obviously equities and diversification of equities portfolios is the topic of the day. So the first question really, I suppose, is why would I look to diversify my equities portfolio?
So I think first we have to understand what is the aim of diversification. So it is not necessarily to boost the performance of your equity profile, because in fact diversification won't ensure a high gains, and neither it will provide a guarantee against losses. But once you set your investing goals, which we will talk about, then diversification will provide the potential to improve your returns and your risk exposure, and most importantly, reaching your long-term financial goals. For example, if you were in love with oil 2 years ago and you had a portfolio composed of one asset class, 5 stocks in the energy sectors, even if they were big names, you would have almost lost more than 50% of your capital. And the same applies also to the banking sector. So ideally, when you diversify your portfolio, you are having what we call uncorrelated stocks, which typically means they move in opposite direction under different circumstances. Let's say when a portion of your portfolio is dropping, the rest will hopefully be gaining. But to achieve a superior kind of diversification, you should want to diversify across the board, not only different types of companies, but also different type of industries. And sometimes it comes to adding other asset classes, which is like fixed income as well as alternative assets. Because, sometimes when we have kind of what we call systematic risk, same what happened in 2008 financial crisis, even the most diversified portfolio in equities would have fallen by much. So probably gold is a good example of an alternative asset also to be included in the portfolio.
Excellent. Okay, and we're talking here, I suppose, about investment portfolios. So things where you're going to hold that for a long time. The idea is to build wealth gradually over time. A lot of what I suppose our listeners and myself and Tom and a lot of the guests we've spoken to recently are looking at is slightly shorter term. So, trading from a few minutes up to maybe holding things for about a year. Does the same thing hold true if I'm going to look to hold? So, for instance, like last week we spoke to a guy who is all about small cap equities trading, and he holds things for a couple of months to 9 or 10 months. Does diversification, is it still as important for that sort of trader?
So when you come to kind of specialized trading or focusing on one asset class, this is something else. So what I usually do advise for any new trader is to have your portfolio, your long-term plans. Like I want this portfolio to be for the longer one, is when I retire, I want to live out of this money. Yeah, and then you can still have a portion of the portfolio which is allocated to taking more risk. It could be through investing in, as you just mentioned, small caps, or just picking some stocks, or even go more risky with leveraged tradings. But at the same time, you need to learn about this world before you dig in, because so many people just get into this industry and they don't know what's the ins and outs, the advantages and disadvantages, and they get burned. So I always recommend get to know this industry first before you dig in. But of course, if you have your savings, you have your equity portfolio or other alternative assets as well inside, then you can take the risk and choose to go for more type of risky trading. And yeah, why not?
Okay. And if you're trading a slightly more high risk strategy, then I guess maybe that sort of diversification for long term blending and smoothing out of the ups and downs is less important.
I think as well, this depends on your financial goals first and what you want to accomplish from this strategy. So, and as well, it depends on the investment time horizon, as you just mentioned. So if you were in your mid-20s or early 30s, it differs than being in your late 50s, because you just have little time to risk it. It also depends on your risk tolerance, as you just mentioned as well. For example, if you lose your mind when you see your portfolio dropping 20% in 1 year, then you should not consider overweighting risk asset classes. So yeah, just depends on the tolerance as well.
Okay, and I guess that's all about knowing yourself and knowing what you want to achieve, isn't it? And then making decisions based from there. So this is really interesting to me, because as you know, myself and Tom are doing sort of day trading with Forex. That's sort of principally where we've come from. But the nature of my career to this position means that I don't actually have a pension of any description beyond what I personally would invest into a shares portfolio if I decided to build a pension in that way. So there is a part of me that thinks maybe I will day trade Forex and continue doing that and try and become successful at that. But maybe a portion of my assets should go into something longer term, some sort of invested strategy. And so diversification sounds key to making sure that when I do retire, if I can ever retire, that I haven't lost it all on one cyclical disaster in the sector I've chosen. So what was key there, it seems, is so if I want to diversify, it's not as simple as just choosing some tech stocks, some oil stocks, some banks. It was more that when some sectors go up, other sectors may be going down, and therefore you want to weigh them against each other, which has parallels with currency trading, where you're obviously trading pairs. So tell me a little bit about that. For instance, if I have a lot of oil shares, is there something else I should also go into? Is it quite simple? Is there a list I can find, or is it more complex?
I think you can make it simple and you can make it complex at the same time. So if you're having like a portfolio which is overweighted with oil companies, then you might think, if oil went down, where can I benefit from? And probably you can find airline companies, or you can find as well countries that do benefit from lower oil prices, such as industrial stocks. So you always have to think this way. If I have this stock dropping heavily, where can I benefit from in other asset classes? And even in the currencies, let me give you an example. We know all what happened after the Brexit. In fact, the FTSE 100, it skyrocketed after that.
Yeah,
3-4 days weird. After that. It was so weird. But at the same time, when you see the FTSE 100 and in pound terms, yes, it appreciated by more than 10-15%, whatever the amount is. But at the same time, if you were living out of the UK and pound is not your base currency, let's say it's dollar, for example, where I'm living here, because our currency is pegged to the US dollar, then I would have lost, I think, around 2-3%. Mm-hmm. So basically, I can buy the FTSE. Yes, I love the companies at the same time, but I can even hedge this investment through shorting the pound. And yes, I would make money through investing in stocks in the FTSE. At the same time, I'm hedging myself against the currency risk. So, there's always a way to think about it. So it's not necessary just to diversify through other stocks. It could be through other asset class as well.
Okay. I mean, you're right. You can be simple or complex there, can't it? I mean, I think you could get into the realms of, true hedge fund management and the things that the guys of the MBAs and the 50 years experience do. Or you could go as simple as saying, I've got some oil stocks and I've got some airline stocks, and they should pretty much balance each other out. Yeah, two different ways of doing it. And I think that sort of holds true for a number of different trading things we looked at. You can go very, very simple, or you can go very, very complex. And I guess that depends on how much time you've got to invest and look into it.
Of course. So if you're not into the financial industry, you haven't studied finance, or you don't have an MBA, an accounting, or a CFA, then just keep learning, but keep it simple as well. For example, even when you're looking to buy stocks, I usually ask these questions to some traders. Do you like Google, for example, or do you like Apple's? Of course, they are great stocks. They are great companies. But at the same time, doesn't mean if I like a company, I have to invest in it. So, liking a stock doesn't mean it's proper investment. Although a company might be doing phenomenally well, it doesn't mean it has a great investment value. So this is when you need to start learn about basics of equity trading, learn about stocks valuation. You have to read some basic analysis on the stock markets as well. So fundamentally, for example, you have to look at the earnings growth, sales, profit margins, competition in the market. You have to look at it from a macro and a micro perspective. So that's why I always recommend is to invest in yourself before doing anything else.
Okay, I guess you're right there. You might really, really like a tech business, but if they're already trading at sort of 30 or 40 times their earnings or something, then there's not much value there potentially.
Exactly. So you just mentioned the PE ratio now, and I could tell you that I've met so many traders investing in equities, and they just don't understand what a PE ratio is.
So this is the price to earnings ratio, which is, I would have thought from the very little I've read up till now, the backbone of equities trading, really, to understand in any way the valuation of the company you're buying. So I'm astounded to hear that you know traders who just ignore it or don't even understand it.
Exactly. And at the same time, like a PE ratio, you cannot compare like a Google to ExxonMobil or Apple stock to to Walmart, for example, or to Tesco. So you need to learn the industry's PE ratio. Yeah. You need to understand what differs from one industry to another in terms of sales, in terms of profit. And need to know sometimes a high PE ratio doesn't mean that it's a bad stock, but it could be a momentum stock, for example. As sometimes Tesla was trading above 200 PE ratio. At the same time, it was still going higher because they have potential growth. So
because they could end up dominating the entire car industry, right? So
exactly.
Yeah. Okay. And is that another aspect then maybe of diversification, is not just across sectors or across product classes, but maybe saying, I need to have some growth stocks in here, stocks that maybe aren't paying dividends, maybe not even be turning a profit, but where they're in a sector or they are a business that my analysis of them says that is going to grow over the next 1, 5, 10 years, 3 months, whatever my time horizon is, and twin that with maybe diversifying with blue chips, dividend paying stocks that will present an income for you as well. Steadier ships, the 50-year-old companies, your big oils, your big banks that pay that regular dividend, and diversifying that way. Is that another way of looking at it, not just across different industries?
I think you started getting there now. So diversifying through different type even of stocks is a kind of a diversification. So when you look at even growth and value stocks, it could be a way of diversification. But I think the most important aspect of diversification first is to look at different asset classes and then zoom in further, whether you would like to have a value stock or a growth stock or a stock that will pay you a regular dividend. And then you can choose from this universe. So number one is looking at the macros, then asset classes, geographic location, and then dig into what type of stock do you need inside.
Okay. And sort of, I suppose, comparing and contrasting this with what we've been learning up to now in sort of day trading or short-term equities trading world, where it's about getting an edge, and finding a little thing in the market that you understand that you can trade and consistently make pips on or points on or make profit on with equities. And I guess that's what you'd call specialization. And we're talking here about, I suppose, kind of the opposite, and diversification. What sort of time horizon of trading, from the short to the medium to the long term, do you think you need to be moving away from trading for an edge? So I guess understanding a certain bit of market mechanics or a certain bit of momentum trading, and saying, well, actually, no, if you're going to be holding these equities for X amount of time, actually, this is now a portfolio, this is now investing, and you should now diversify. What sort of time horizon is that? Is that cut off, would you think?
So usually from a long-term perspective, I always recommend looking at your portfolio on a quarterly basis.
Okay.
And then you can adjust whenever you feel that this is necessary. I know some traders, they can just buy 10 stocks and keep it for the next 20, 30 years. And some of them, they were successful in this, but some other times it was a disaster for them. So in terms of investing on the longer one, you should probably look at your portfolio, how is it doing on a quarterly basis, look at what changes is going around. I mean, now if you look at the current situation in the markets, we can see there is a lot of uncertainties going on. And I've interviewed a couple of hedge funds on CNBC show, and they all have like kind of question marks that we could be heading for like a 10, 15, 20% fall probably in equity markets. So you should be aware of what's going around, even though when you look at the longer one, okay, you could say, yeah, we can see like a 10, 15% drop now. I am very well diversified. It doesn't matter. After 1 year, my portfolio will pick up again. But at the same time, if you can hedge your portfolio at the, like in the next 3-4 months through either diversifying or changing your asset allocations or adding some fixed income, for example, or even buying some put options on your investments. So you should be looking at regular basis on how your portfolio is performing and learn the reasons why your portfolio could be dropping or going higher. And this will lead you to become like a better investor.
Okay, excellent. So some really interesting thoughts there on the difference between sort of short-term trading and longer-term investing, and the different attitude and things we need to be looking out for, more about diversification and almost defensive investing, as opposed to that very, very proactive getting an edge and trading a specific thing that we would do in the shorter term. So some real lessons learned for us, and I think there might be a place for us to twin that with our day trading in Forex, to have an ongoing portfolio. So thanks very much for bringing that to our attention. Just before we go, what would you say is 1 or 2 bits of practical advice for someone like me, someone who's been day trading to now, but is interested in putting some of their assets into a longer term portfolio?
So basically, as I mentioned, learn the fundamentals of equities, get to know more about how does companies perform, what does ratios mean, look at the earning growth, sales, profit margins of a company, and return on equity, among other things. So this will help you narrow your choices when you're picking up stocks into your portfolio. And even, you know what, technical analysis also apply on portfolio management. If you're looking even on the longer run, technical analysis can involve on whether the price is good. Same applies even on the longer run when using technical analysis. Just becoming like a long-term investor probably requires some different type of research than the day trading stuff, especially when you're trading like heavily like leveraged products. But I think just make it simple, learn more, take your time to invest in yourself. I think there's so many resources where you can read from all over the internet, and then just get into this.
Excellent. Good advice. Tom, anything from you, or do we think we've gleaned the information we need from this one?
I've gleaned more than enough information from this one, but
Excellent.
I mean, the only question I would have is, as young and aspiring investors as well as traders, I mean, what return could we be looking for, as kind of inexperienced guys on an annual basis? Is it quantifiable, or is it completely depending on market conditions?
I think this is probably one of the tough questions nowadays. Because I think if answering this, we have to dig more into economics and what's going on.
Okay.
So I mean, like if we go back like before the financial crisis, when we used to have average economic growth of 4 or 5%, then we were expecting around 8 to 10%, let's say, on a very well diversified portfolio for the longer run on annual basis. But now with the growth dropping probably towards 3%, if you look into the US as well, the longer term perspective, we're looking at below 2% growth. So I think this whole thing is going to be changed. And we'll no more be looking at like high profits or annual income coming from even a very well diversified portfolio. But as I just mentioned, we have to dig more into economics and then say why we expect lower returns on the longer run.
Okay.
Yeah, that's probably a reasonable answer. I know you just wanted to say 15%, but
yeah,
that's the reasonable answer.
Yeah,
cool.
guys.
Well, Hussein, been a real pleasure having you on. Thanks so much for giving us your time to come on and talk to us about this. Food for thought, tongue twister. Food for thought for us guys to go and think about this in terms of potentially putting together a more long-term portfolio. So cheers, and I'm sure we'll speak to you soon.
Thank you, guys. It was great being on your show, and best of luck.
Thank you.
Thank you very much, Hussein. Yep, so equity trading is massive, and it's just hit me how much we're going to have to learn. And I don't know what you think, Owen, but that is now, this month is more of a fact-finding month as opposed to giving me an opportunity to start trading equities, because there's just so much to learn that it's quite daunting for me, at least.
Yeah, I mean, we've been doing forex trading for several months now, and I personally still am quite, I'm still some way from nailing down exactly how I'm going to trade. I'm much closer, and I'm and I know you're the same, Tom. Although maybe technical trading is going to be more for you, nailing down what you're going to choose and what works for you, and actually something you can consistently be profitable with takes time. Mm-hmm. So if you're just switching gear and going, we're now going to be equities traders starting next month. It's not as simple as that, is it? It's we need to give forex a fair crack of the whip. But I like you, it's a fact-finding mission. This is all about finding out whether it's going to appeal, if it's something I want to do, and which bit of it, because it's like forex, it's massive. Which bit of it would appeal?
Yeah, and it certainly appeals to me. It really does. It's something more for me in my head. It's something more tangible than FX. I don't know why. I don't know whether that's complete bollocks.
For the real
or not.
Companies, I guess, man.
Yeah,
you actually own them.
Yeah, I mean that's exactly what it is then. So that really does appeal to me. But again, the people we're speaking to, they've got so much knowledge, and that's the level of knowledge you need to get to before you start investing money in something like that, or trading money with something like that. So It's going to take a little bit longer than that, but luckily enough, we've got as long as you guys want to listen to our voices to learn.
Yeah, exactly.
Yeah.
And you know what's interesting for me is I think, I don't know, I'm probably going to absolutely hammered for this, but I wonder if you could day trade Forex, get good at that, but then maybe take a little bit of the risk off the table and buy your blue chips, your dividend paying shares, to build up a portfolio for a pension ultimately, because, and shove that inside an ISA, something like that. Because, as I mentioned, I think earlier, the nature of my career has been working with small companies, and for myself, I don't actually have a pension. I'm not exactly pushing retirement age. People our age probably aren't going to get to retire, but actually, I could. I was just reading a little bit about Jesse Livermore and reminiscences of a stock operator, that guy, and how he made and lost several fortunes. And you just think, you could get really good at Forex trading, build up a huge trading account, and then just markets change, you don't understand what's going on, you go a bit peculiar and blow the whole lot and have no assets, nothing to show for it, nothing elsewhere. Maybe just saying, look, spend a bit of time learning how to pick and choose decent, large cap blue chip companies and build up a bit of a portfolio might not be a bad way to do it.
The whole about diversifying your risk and portfolio and all that kind of stuff, which you learn about. So yeah, maybe you're right, but again, that's a few months and potentially years down the line for us, mate. Let's just get good at trading first, and then we'll look at other opportunities.
Yeah, roger that, mate. All right, so we've got 1 week left of equities month. We've got a great trader lined up, someone who is a profitable equities trader. So we're looking forward to chatting with him next week. Tom, do you have any final thoughts?
No, I'm probably going to have a nice lie down and rest for the rest of the day, I think.
Excellent. And can you hear my dog going insane in the background?
Well, that's a good end of the podcast.
Yeah, okay. That's the baby's health visitor that's just turned up. But all right, yeah, so enjoy your lie down. Just for those who don't, Tom has just come back from the British Army's toughest patrol competition, where you won a silver medal, which is no mean feat to anyone that knows anything about Cambrian patrol. So congratulations.
Right. Didn't want to mention it myself, mate, but now you've brought it up. Yeah, it is quite a big deal,
Yeah, I'm a pretty big deal, eh? Yeah, you deserve a lie down. So just produce the podcast, get it out, advertise it, tweet it, get it all out on social media, and then you can have a lie down.